Hey everybody, welcome to Regulatory Joe. I'm Joe Boyle, president of ClearFile, and today I'm pleased to introduce Greg Fann of Axene Partners to discuss Plan Year 2027 NBPP and specifically catastrophic plans. Greg, welcome to the show. Tell us about yourself and Axene Health Partners.
Well, thank you, Joe. I'm a healthcare consulting actuary. I have been a health actuary for over 30 years, and for the last 10 have been with Axene Health Partners based in Southern California. I do a lot of different things in the healthcare space, but probably about half of it is related to the Affordable Care Act, and I'm probably more non-traditional in the sense that I'm more involved in some of the policy strategy dynamics that are going on, which I think is probably how you decided to talk to me about what may change from a policy perspective.
Sure. No, and thank you for your time today. We know you've been very busy, boots on the ground, following everything from the industry side, going across coast to coast. And so for the purpose of today's call, we were just very excited to pick your brain and to educate both ourselves and the industry about this topic that is seemingly complex, but that can also offer the members for Plan Year 2027 potentially richer benefits against the headwinds of the ACA, specifically with the elimination of subsidy eligibility. What exactly did change between Plan Year 2026 and the proposed rule for 27, specifically as it relates to catastrophic and/or bronze plans?
The catastrophic plans are an interesting dynamic. They are part of the Affordable Care Act, which was passed back in 2010. And so they offer the same essential health benefits with the annual limit protections, the lifetime limit protections, the essential health benefits that the ACA provides. From a benefit standpoint, they're really comparable to the ACA as opposed to other plans that you would term non-compliant, like short-term plans, which have different benefits, different coverage levels. I've even heard catastrophic plans referred to as, quote, junk plans, which is really a pejorative term for non-ACA plans. But it's important to remember these are actually plans that were created by the Affordable Care Act. And the benefits they provide, again, they're ACA benefits. And there's been some interesting aversion to this plan expansion in 2026, 2027. And it's coming from really a lot of different places. I think what's fascinating about it, we'll look at AHIP, the industry leader in representing health insurers. Back in 2014, 2015, they were arguing that catastrophic plans were lower priced, particularly of value, and they should be on the metal level exchange as well and be subsidy eligible and can provide subsidized consumers better coverage. But with this expansion, that they've said they may be good for certain uses, but they're really not a replacement for comprehensive coverage. So again, kind of leaning into this idea that the benefits are bad. And I think that if you really look at the issue with catastrophic plans, it's really not the benefit difference. They are effectively bronze plans. The actuarial value is 55% as opposed to 60%. So from a benefit standpoint, once you have that plan, it really acts a lot like a bronze plan. It is structured different. The deductibles are higher, but from a pure value standpoint, it's really very similar to a bronze plan. The difference is not the benefits. The difference really is the premiums. And the premium differences are due to two things. One, from a gross premium basis, it's on a different risk pool. So to the extent the people that enroll in catastrophic plans have a different morbidity risk mix than the metal level plans, the price is going to be different. For example, let's just say on average that it varies by state, but let's say catastrophic plans are 20% cheaper than a bronze plan. 5% of that is benefit value. 15% of that is just pure risk pool. So you're getting a benefit that's 5% lower for 20% less. That's a good deal for consumers. That's a great option. And the other difference is the subsidy eligibility. They're not on the exchange from a metal level perspective, so they're not eligible for subsidies. So if you're subsidy eligible, you're probably better off in a bronze plan, unless your subsidy is so low that the catastrophic plan still beats it on price on a subsidized basis. The two things that are part of this rule that I think perhaps need to be fleshed out is, one, there was not a proposal, but a question from HHS. Should these plans be moved to the metal level, a risk pool, and everybody's saying, and that would defeat really the entire purpose of the value that these plans could add, which really isn't significant. There's really no harm in it because it provides consumers more options, but It's a minimal sort of administrative process that the Trump administration had, which is very limited. And the other thing that's gotten a lot of attention is what I would call really this pilot experience of multiple year coverage. That's where an enrollee can have the same premium for up to 10 years, which really means the insurance company has to price that higher on the front end so that if someone's willing to pay that front end price, they're going to stay much longer because their premiums aren't going up with medical trend. And the reason for that is, and this is nothing new, this has been going on from since we've invented medical management, is that insurance companies are hesitant to invest in promoting health for consumers for a long-term basis because they don't usually keep consumers for a long time. What's the financial benefit of providing good cardiac care if the consumer is going to beat your competitor 5 years later? There's some, I think, real expectation that with a catastrophic plan, if somebody buys this 10-year product, they're going to stay in that product and there's an opportunity to invest. So it's a pilot. It's not going to restructure the ACA market. It's going to be very small from an enrollment standpoint in what it's going to do. So I hope they got us started in a good spot.
No, that's incredible, Greg. And see, that's the thought leadership and the actuarial lens that we've really been looking for in terms of disseminating a policy like this surgically and applying it. And again, this rule could be disproportionately used across the size of carriers with different capabilities. Larger carriers may react differently to this eligibility, differently than a hospital-owned plan or a regional plan. And I say that because when we're looking at this, you have a healthy understanding of how having a higher cost product may glare off the page to a member who doesn't understand the longer term approach or the strategic approach to this. Because from where I sit, from more of a product filing or delivery perspective, we know there's the lesser of rule, where there are certain states or a handful of states that require at least one carrier or one issuer at minimum to offer a catastrophic plan within any given state. And then again, those other carriers have an opportunity to then withdraw their catastrophic plan, but they always have to have one somewhere in the background for at least a couple states. So now that you've described, the catastrophic plan could over time be that normalized benchmark-based lowest cost plan. We think about member behavior. How do members shop? Is it based on price, based on brand? Like you said, if this can actually secure a member into a plan for 10 years, regardless if another company has a stronger brand, and that could still help a carrier win. It's a win-win situation. So that being said, if you were to advise today, leading up into plan year 2027, against these tight timelines and deadlines, filings are due in the next 60, 90 days, what's one or more strategic approach, or how would you advise an issuer strategically to really harness this rule?
Yeah, I think that's fascinating. If I could lead in maybe with one interesting tidbit, is I just found out maybe 2 weeks ago that a carrier in 2026, when everything happened last summer with the announcement with the Centene and the Wakely, that sort of really catapulted at least attention to states allowing carriers to refile rates based on new information. Some states basically allowed carriers who didn't have catastrophic plans to add catastrophic plans at that time because the expansion was occurring in 2026. So just the interesting dynamics of that's not the way the ACA was designed to do this mid-year stuff, but that was going on in 2026. For carriers thinking about catastrophic plans, I think the most interesting dynamic, and this goes back to kind of the stronger single risk pool enforcement that we've seen in some states and what that has done to metal level pricing and metal level offerings. As you've seen gold plans become cheaper than silver plans as they are in 20 states, 1-to-1 right now on a national average basis. But that has really created a environment where there's not a need for bronze plans in the subsidized consumer world because nobody should, from a financial utility standpoint, nobody should buy a bronze plan. You can buy a gold plan, which is much richer, for maybe free, maybe it's a little bit of money, but you're leaving subsidy dollars on the table with a free bronze plan. You are better off in a gold plan. This is for the people above 200 that aren't eligible for the rich CSR benefits. So basically, you don't need a bronze plan in the market. You really have silver and gold. What's driving it? The source of attraction for bronze plans is really the unsubsidized enrollment, which is very small and now less than really 10% of the market. They are best off buying the lowest price plan that's available, and it has been that bronze plan. Now a catastrophic plan is available. And if you're not receiving subsidies, that takes away the need for a bronze plans. And in states that are, particularly states that are strong with single risk pool enforcement, there are complaints that risk adjustment methodology is unfair to bronze enrollees. So where I'm going with this is I expect to see plans dropping bronze coverage because that unsubsidized market now could be catastrophic if those plans are available, if the risk pool is cheaper than the metal level risk pool. You have catastrophic plans for your unsubsidized population. You have silver plans for your 100 to 200 population. And then above 200, you have gold plans, which are available. You don't need bronze plans in a market where gold plans are cheap and catastrophic plans are available.
And I'm so glad you brought that up because that begs the question. And even before the NBPP was draft released or even available for issuers or carriers, there was even looming discussions about the introduction of net new metallic tiers to encompass any new AV values that fall out of range, such as a copper plan or other metallics that could represent something that we're talking about today. But to your point now, see, I'm learning so much right now because I understand the relationship much more strongly between the cap plans as well as the bronze, and also even the sister plan, the expanded bronze plan that expands that AV. It's really interesting because you mentioned, I believe you just said 10% of the market, roughly speaking, is in that bronze metallic tier. But then, at ClearFile, when we look at overall member population and where the majority of our members sit, which plan of coverage in which geography or rating area, we look to carriers' population health data. And when we look at that data, we're able to slice and dice it a number of different ways. Population by region, if these members are new, renewal, or coming from another carrier, if they were mapped from CMS, or mapped by way of product or plan on the crosswalk. With 10% of the market being just roughly about in that bronze category, how many members are truly eligible for the catastrophic plan? Is it less than that, the 10%? Is it somewhere in between? Or would you even consider like the cat and bronze plan, like that total 10% of the national market? And do you see that population growing or do you see it remaining where it is today?
Yeah, so I should clarify, the 10% is the percent that's unsubsidized. There are clearly some subsidized enrollees that are in bronze plans. Some people just want free coverage. Even if it's better to buy a gold plan for $20 or $30, some people just don't want to pay. They want to stick it to the insurance company and not give them any money, and they're gonna take a bronze plan. So bronze plans are pretty popular for the people that are not in that 100 to 200% category. I think I'd like to answer that, and I think this is where there's a lot of confusion, is what's the rationale for this expansion? I think, and this is where there's this reactionary issue that, hey, this is in response to premiums being up in 2026. This is in response to the enhanced subsidies expiring. This is a solution to all that. It's not a solution to all that. It's a very limited relief for a small group of people. And then there are opportunities, as I said, for carriers to take advantage of this by saying, hey, this is now a solution for unsubsidized people that they didn't have before that bronze plans were providing, which are harmful to us from a risk adjustment standpoint.
I hope for all the listeners out there that you're taking notes because this is highly valuable in terms of understanding the role to apply it, how it's intended to be applied. All the carriers out there who are looking at this in slightly different ways and making slightly different decisions based on their risk pool or where these members fall on the spectrum, how likely is this rule to get modified on an annual basis through the NBPP?
I think there's a lot of things that kind of would play into that. I think what happens with the single risk pool change, does that get legally challenged? That's the big issue right now, is states that have strengthened their single risk pool enforcement to be in alignment with federal law and alignment with federal rules at the time. Now you have some federal rule changes that are conflicting with that. And again, that was a Biden administration change, but the Biden administration was very clear. We're still deferring to states as the regulators. We don't really expect this to have any change. Well, the Trump administration is effectively affirming the Biden rule, but putting some, I don't know if you want to use the word teeth behind it, in the form of enhanced reporting of showing alignment with this new rule. CSR reporting is what it's called. It's expected to cost insurers $400 million a year just to report this. And they have said that we expect this reporting to spotlight the differences between practices, again, which this is mainly in states that have implemented rules to comply with federal law, that now are going to be in conflict with this rule. Where does that go with litigation? Because that's a big part of what made the catastrophic plans attractive to this population. I also think it matters is, does this take off? If this is a dud and nobody enrolls, then it's easy to get rid of it. If this becomes popular and you get people enrolled in it and you start to grow the unsubsidized market, it needs to be attractive for people to the extent that we start growing the unsubsidized population, whether it's through catastrophic plans or something else. We'll have to see what carriers are doing. I think it's a lot like ICRA's. It's a good value, but you got to have people interested in it really from a lot of different perspectives for it to really work. So I think you have to have states, brokers, insurers, and consumers all on board with this. In a normal world, this really wouldn't be attractive to people, but why it's become attractive, I think, is because the ACA metal levels are not attractive. And again, I think that's primarily the unsubsidized population and what we do there. Thinking out loud, reinsurance waivers, if they take off again, I'm not sure that's the right option, but that sort of reduces the metal level gross premiums by 20-30%. That kind of takes catastrophic plans off the table from a price relationship standpoint. I think bigger things are going to drive what happens with catastrophic plans and their viability for a large population.
No, that makes perfect sense too. And as your big key takeaway, I think you hit that right on the head. And plan year 2027 being a pilot year to actually measure, understand metrics, understand performance of the plan, and also the quality of the service that the member's receiving and their happiness of that plan. Now, it's interesting because we do see just state level nuances because the federal rule comes out, proposed draft to final, and in between that pocket of time, we have states that react to the NBPP. So we can already anticipate, depending on if new state policies, mandates, or other gets released throughout May and June and July, responding to NBPP and or if it does impact this catastrophic bronze discussion that we're having right now. How do you think, if at all, states would react to this, or do you think on a state level this product may have more state level requirements or even rescinded requirements? So I'm thinking about certain states, primarily more state-based exchanges maybe rather than FFEs. Massachusetts comes to mind. They do have the Massachusetts Health Connector, which really touches on everything you said, such as offering CSR or cost share reconciliation wrap support in addition to subsidy eligibility. But then we do know that they have their state-based RFR, which they have a consortium of sub-requirements and also standardized plans. Do you see any adverse state reaction to the federal rule?
State reactions are all over the board. And if I'm critical of state reactions, and I have been in some articles for a long time, of doing things that look good on paper, sound good, people understand, and neglecting doing really smart, wonky things that don't get any political credit because nobody knows what you're doing, but it's really helping consumers. I would like to see states do more of things that really help markets and make a difference. In terms of timing, I would expect states to do more during their process and after, just based on how late the NBPP was this year, and there's not going to be a lot of time afterwards. And insurers need to know and start doing stuff now. And so as I'm talking to my clients, it is more like we're in rate filing season and let's do what we know how to do and have some sort of placeholders for all this stuff we're waiting on. It's not let's wait till the NPP is done and then start doing our filings. It's on the go now. So I think it's a little bit different environment this year. And I also think that to some extent, states have to wait and see what insurers do. For example, if a state gets every insurer in their state that gets rid of bronze plans this year, and they weren't expecting that, they now have a different view on catastrophic plans than they did beforehand. Or maybe they want to be a little more rigid and mandate bronze plan offerings like states like California have done. I think understanding what their insurers want to do, I think also is going to impact the state dynamics. And they may be talking to their insurers about this stuff. They may not. They may have to just wait till they get their rate filed. I think there's a lot at play that is different this year.
I entirely agree. And like you just mentioned, I know some states have collective issuer calls where they kick off their filing season, such as Nevada and even Colorado, where carriers are all in one room where the state reviews their expectations for that year. Those are happening, quite frankly, in this process. And Greg, this has been a great discussion. I have to ask, I know we've covered a lot. Is there anything that I didn't ask you that you find would be valuable to your partners, your customers, or any issuer listening in. Because I know this is iterative. It takes a lot of time and resources to review this rule. You've spent a considerable amount of time with your team. A lot of other issuers haven't had that time or that priority.
I think from a closing standpoint of what to understand about catastrophic plans and the impact is to maybe draw in the other thing that's gotten a lot of attention on the NBPP, which is the non-network plans, because I think that's where non-actuaries really miss the dynamics. There's always this intent to be concerned about market harm and what's going to harm the ACA market. And things like short-term plans, anything outside the market really doesn't harm the ACA market because most people are subsidized and the premium they pay, it's a percent of their income, which is fixed, plus the premium for the plan they select, minus the premium for the benchmark plan. So what really determines market health and consumer value propositions is the relationship between plans and the benchmark plan. So anything that changes that relationship, anything that I guess raises the benchmark premium makes it better, anything that lowers the benchmark relative to the plan makes it more challenging. So catastrophic plans, that's outside the market. That doesn't impact this dynamic. So it's another option, maybe better for some people, but it leaves the ACA structure in place. The non-network plans, on the other hand, are within the exchange. They become part of the metal level plans. And if they're insurers that are mandating these cheap prices, they're going to have low premiums. They're going to take the place of the benchmark plan, which is going to reduce subsidies and make everything else cost more. So these two things are not the same. They're much different. And it's much the same like public option, put that in air quotes, public option plans that come in and capture the benchmark and say we're lowering costs. No, you're not. You're just making the cost more expensive for consumers for everything else. And that's the interesting political thing about this. If they called the non-network plans public option plans, you'd have an entire different constituency complaining about it, but it does the same harm by reducing the benchmark and making everything else more expensive. So I think non-actuaries, I know it's wonky, but the way to think about what hurts and harms ACA markets is, does the plan get in the way of the market? Does it change the relationship between the plans people buy and the benchmark plan in terms of premiums? Because that's what drives the prices that consumers pay. Catastrophic plans don't have anything to do with what people pay for our gold plans. Doesn't matter. 2 million people enroll. It's not going to change. Be concerned about what's in the ACA market, whether it's called a public option, whether it's called a non-network plan, whether it's called a lionfish, as I like to say, that disrupts the benchmark and has an artificially low price, which lowers the subsidies and makes everything else cost more. That's really where the focus should be, and that's where my focus has always been.
I'm so glad that you ended on this thought, Greg, because honestly, from a non-actuary speaking to an actuary, I will say, generally speaking, from a filing perspective, we start with product management, defining product strategy, then moving on to pricing that decision that's already been made. Now, with what you just said, it may be not a bad idea for issuers to lead from the actuarial lens going into this year and then mitigating with product strategy, having that information so that it's not wasting time creating rework or errors. But no, this is great and it's been fantastic. I'm thrilled to have you on the show, and I know our audience is going to be taking notes and probably reaching out to you. And with that respect, tell us, where can we find you? Where can we find Axene Health Partners?
Sure. You can send me an email, certainly. It's greg.fann, F-A-N-N, at axenehp.com. That's greg.fann at axenehp.com. You can also find our website and my information, cell phone number. Everything is on there. As Joe and I are talking, happy to have the same offline conversation with all of you.
Great. I hope many people take you up on that, Greg. And no, it's a pleasure having you and seeing you again. Thanks, everybody, for listening in. Give us a like, give us a share, and we'll see you all next time.